Welcome to CoreLogic's update on housing market conditions for June 2019, brought to you by onthehouse.com.au. We saw a variety of outcomes and announcements through the second part of May and into early June that are likely to bode well for the housing market, including stability in the federal government, an announcement from APRA that borrower serviceability assessments were likely to improve by late June, and the RBA cut interest rates to a new record low on June 3rd. All this good news wasn't enough to stave off a further decline in dwelling values in May. However, market sentiment does seem to have improved over the second half of the month. Although dwelling values fell in May, the pace of decline continued to ease off, a trend we've been seeing since early 2019. Nationally, dwelling values were down 0.4% in May, which was the smallest month-on-month decline since May 2018. This improvement is primarily being driven by a slower rate of decline in Sydney and Melbourne, where housing values were previously falling at the fastest rate of any capital city. Sydney values were 0.5% lower over the month, while Melbourne values were 0.3% lower. That's the smallest decline in values across both cities since March last year. In other cities where housing market conditions have generally been more resilient to a downturn, the trend is the opposite. Hobart values have tracked lower for 2 months running, taking the rolling quarterly change in values into negative territory for the first time since early 2016. And with Canberra values 0.2% lower over the month, the quarterly rate of growth remains only slightly in positive territory at 0.2%. While the pace of value falls has eased across some cities, the Australian housing market remains in a geographically broad-based downturn. Adelaide was the only city to avoid a slip in housing values over the month, and in the rest of state areas, South Australia, Tasmania and the Northern Territory were the only regions where values rose in May. In fact, regional Tasmania is the only broad region across the country where housing values remain at a record high. The slower rate of decline is also visible in higher auction clearance rates through the month. The last week of May saw Sydney clearance rates break the 60% mark for the first time in a year, while Melbourne clearance rates have held around 60% over 3 of the past 6 weeks. Although clearance rates remain low relative to several years ago when housing market conditions were much stronger, the improved performance at auction aligns with the easing rate of decline. Since peaking in October 2017, national dwelling values have reduced by 8.2%, with values across the combined capitals down 10.1%, while regional values have been more resilient, falling by 3% since peaking. Larger capital city falls have been recorded in Darwin, which is down nearly 30%, and Perth, where values are down by 19%, as well as regional WA, where the mining downturn has led to persistently weak economic and demographic conditions that have weighed heavily on home values. These regions now represent some of the most affordable housing markets around the country, a factor which explains the high proportion of first home buyer participation in these markets. The last time values were this low in Darwin was back in March 2007. In Perth, values were previously this low in April 2006, and values haven't been this low across regional WA since July 2005. Now let's take a look at the trends across each of the capital cities in more detail. Sydney dwelling values continue to trend lower in May, down a further 0.5% over the month to be 14.9% lower relative to the market peak back in July 2017. The good news for homeowners is that this was the smallest month-on-month decline since March last year. Dwelling values are falling, but nowhere near as fast as they have been. Auction clearance rates have bounced higher, holding above 60% over the last week of May and the first week of June, providing another indication that housing prices are closer to finding a floor. Another evolving trend is that unit values are now falling at a faster pace than house values. The past 3 months has seen house values fall by 1.9%, while unit values are down a larger 2.3%. Potentially, we're starting to see some weakness in the unit market as the unprecedented amount of new units settle and move into the resale market. Melbourne dwelling values continue to trend lower in May, down 0.3% over the month to be 11.1% lower since peaking in November 2017. Although values are still falling, this was the smallest month-on-month decline since March last year and continues a trend of diminishing declines that's been evident since early February this year. Despite the ongoing falls, Melbourne dwelling values remain almost 24% higher than they were 5 years ago, highlighting that most homeowners still hold a substantial amount of equity in their homes. While dwelling values trend lower, rental rates are rising, albeit relatively slowly. Rents were only 1.5% higher over the past 12 months. However, with dwelling values almost 10% lower over the year, gross rental yields have risen sharply, up 3.2% from a year ago to 3.7% in May 2019. Brisbane housing values were down 0.5% in May, with falls confined to the detached housing sector. Unit values actually rose 0.1% over the month, breaking a long-running trend of falling values. The oversupply that's weighed down the Brisbane unit market has mostly been absorbed due to the combined factors of less construction activity together with rising population growth. However, Brisbane unit values remain 12.5% below their 2010 peak. With migration rates lifting, supply under control, and generally healthy levels of housing affordability, the Brisbane housing market fundamentals are looking healthier compared to most other capital cities. Adelaide was the only capital city to avoid a fall in housing values through May, with the CoreLogic index rising 0.2% over the month to be 0.4% higher over the past 12 months. Housing values and transactional activity are generally holding firm across Adelaide. Compared with most of the other capital cities, this is actually a reasonably strong result. The median selling time is also held reasonably firm at 43 days. However, vendors have been discounting their price expectations in order to make a sale, with vendor discounting rates rising from 4.9% a year ago to 5.3% in May. The Perth housing market downturn eased off a little in May. However, dwelling values are still trending lower, down 1% over the month and 8.8% lower over the past 12 months. The ongoing weakness in the housing market can be attributed to a mix of weak economic and demographic conditions overlaid with a tight credit environment. Perth housing values are now amongst the most affordable amongst the capital cities, with a median dwelling value of $436,000. That's only $4,500 higher than Adelaide's median dwelling value. As infrastructure spending picks up and commodity prices remain high, we could see local economic conditions start to improve, which is the key missing ingredient to the housing market recovery. Hobart's housing market recorded a second month in a row of falling dwelling values. Hobart's housing values were down 0.4% in May, taking the quarterly result into negative territory for the first time since early 2016. Tighter credit policies together with affordability constraints are the key factors slowing what has been the strongest performing market over recent years. Despite the recent slippage in values, Hobart dwelling values remain 35% higher than they were 5 years ago, highlighting that some homeowners have seen a substantial wealth boost, but prospective property buyers have struggled with worsening affordability. Darwin housing values slipped another 1.6% in May, taking the cumulative decline in values to 29.5% since the market peaked back in May 2014. In a positive sign, settled sales activity has levelled out, with the number of dwelling sales lifting 0.4% year on year, and gross rental yields are substantially higher than any other capital city at 5.7% for houses and 6.6% for units. The high rental yields are a byproduct of values falling at a faster rate than rental markets. The past year has seen Darwin dwelling values fall 8.6%, while weekly rents are down by a smaller 5.2%. Canberra values posted a rare decline in May, slipping 0.2% over the month, but remaining 0.2% higher over the rolling quarter and 2.4% higher over the past 12 months. Although both houses and unit values were down slightly over the month, houses have generally shown a stronger performance relative to units, which is likely a reflection of higher medium to high density supply across the marketplace. Vendors remain in a strong position across Canberra, with a median selling time tracking at 44 days and discounting rates the lowest of any capital city at just 3%. Since the federal election, we've seen a variety of outcomes and announcements that are likely to have a positive effect on housing market conditions. The federal election outcome has removed the uncertainty surrounding taxation reform, which should see an improved level of confidence amongst homeowners and prospective buyers, particularly investors. Additionally, now we've seen some certainty around the initiatives announced in the federal budget, a consistent commission structure for mortgage brokers, who comprise around 60% of mortgage originations, and the eventual stimulus for first home buyers in the form of a federal government deposit guarantee, although that's limited to 10,000 participants with at least 5% deposit. That will kick off in January next year. Another positive announcement came from APRA late last month, where we are likely to see the serviceability assessments used to qualify borrowers for a home loan reduced sometime in late June. Dropping the interest rate serviceability test from the current level of 7.25% to a 2.5% buffer above the going mortgage rate will help to improve access to credit and enable some borrowers to obtain a larger loan. One of the factors contributing to less activity in the housing market has been the challenge involved with accessing credit. While there are a variety of other policies that will continue to keep a lid on housing credit, a more practical assessment of borrower servicing capacity is certainly a positive for housing market demand. Another factor that should support housing market conditions is lower mortgage rates. The RBA cut the cash rate by 25 basis points in June. Mortgage rates are already around the lowest level they've been since the 1960s, and we're seeing lenders passing on most, if not all, of the rate cuts through to home loan mortgage rates. Lower interest rates have typically shown a positive influence on housing demand. Importantly, lower rates may not provide the same level of stimulus as what we've seen in the past due to tighter credit policies, but no doubt lower rates together with lower serviceability assessments and the removal of the uncertainty surrounding the federal election will provide some positive influence over the housing market. While the outlook for the housing market is looking more positive than it was pre-federal election, a variety of headwinds are still at play, especially in the credit space. Although interest rates and serviceability tests are set to reduce, lenders continue to scrutinise incomes and expenses much more intensely. Comprehensive